Let's ask Tom Lee. He's FundStrat's Chief Investment Officer and Head of Research. He's here with us at Post 9. In the market, good to see you, by the way.
Great to see you.
The market clearly doesn't think that tariff turmoil is going to hit the economy and stocks. Is that the right way to think about it?
Well, I think the economy, we've had enough data to know that the tariffs aren't necessarily hurting the consumer wallet or hurting jobs growth yet. But we're just waiting for, as Fed Chair Powell says, to see how it shows up in inflation. So I think the next two inflation reports are going to be closely watched, because if we don't see a meaningful pickup in core inflation and consumer inflation expectations don't move up, then it's going to give the Fed a lot more comfort about cutting over the next 12 months, and that would be good for stocks.
The president continues to talk tough as it relates to tariffs and his trade war. The market, I think, is continuing to reflect a I don't necessarily believe you mentality, that the tariffs are, in fact, going to end up on August 1st, as bad as they sound today or may sound in the days leading up to August 1st. Is that how you think the market is taking it right now?
Well, I think the market's somewhat pragmatic, and they realize the president is making statements to try to force negotiations to come to a close. But at the same time, the president is practical and knows that he doesn't want to upend the economy. So I think the market is trying to manage that balance. And yesterday was a day where they weren't so sure. That's why I think we had a lot of selling. But I think, as time passes, I do think at the end of the day, we expect the White House to find something that is a good balance between the two.
All right. So you're going on the idea, it sounds like, that you think tariffs aren't going to be as bad as the bark would suggest. Is that at the end of the day? Is that right?
That's right. I mean, tariffs are already annualizing $2.4 trillion a year, which, if you now compare it to where the budget is, it's actually neutralizing, the current budget. But it hasn't hurt the wallet and consumer confidence, and it hasn't hurt S&P earnings. So I think at the end of the day that we've had enough time pass that investors can sort of breathe a little bit of a sigh of relief and realize the tariffs, they're important to the White House agenda, but they're not going to necessarily derail the economy.
What if there's too much complacency around that? Got a VIX at 16. You said it's too soon to tell. That's why Chair Powell is waiting to see what happens with inflation. What if we just don't know yet what the real impact on the real economy is going to be?
That's true. That would be a negative fork if that were to happen, and I think the VIX would go up.
Well, isn't that a real possibility? Actually, it's a certainty. Today, we don't know. Do we?
If we went down that path, then it would also open the door for the legal challenges to come back about what kind of tariffs can be levied without an appropriate process. So I think at the end of the day, look, investors should keep that in mind, but then they should realize we had a black swan develop in April.
April 2nd.
April 2nd, a waterfall decline in stocks. The VIX went to 60, and everyone thought the market wouldn't recover because the Fed wasn't going to unleash liquidity, but it was a V-shaped rebound. So if that should be in people's back of their mind, they shouldn't be too bothered, even if we get a bad chapter in this tariff story.
What's priced in at this point? I keep hearing from people, well, a lot of the good news now, given the rally back and the V-shaped recovery that you said, now all of this good news is priced in. Is it?
I'd say that the ones who are saying it's priced in are a lot of the folks that missed the rally. We speak to a lot of high net worth and hedge funds. Many have missed the bulk of that rally, and they are very skeptical here.
They're mad and they're hating on it now?
Yes, that's why it is the most hated V-shaped rally ever. Worse than 2020 and 2022. But I'd argue that the PEs should be expanding. The median PE, the S&P, is lower than it was on the eve of COVID 2020 by 1.5 turns. Mm-hmm. So the market's cheaper, and we had 6 black swans. We had COVID, we had the supply chain shock, we had the inflation shock, the Fed's fastest hikes in history, we had Trump Armageddon, and then we had the U.S. bombing Iran nuclear facilities. 6 black swans. Mm-hmm. The market produced earnings growth the entire time. If this was a stock, we would say it's sort of indestructible, and we should give it a higher PE, but the market derated.
All right, I'm writing down as you were answering that question. Can the multiple expand while earnings and margins are contracting? Can that happen? Because margins or probably contracting a bit, right? I mean, unless you're passing through all these costs to your customers, which I think a lot of companies are reticent to do. Earnings, we know, are contracting because estimates have come down by near half.
Yeah. Now, on the margin side, you have to keep in mind that if, let's say, companies are eating half the tariffs, the gasoline already offsets that. So I'd actually say there's no margin risk from the current level of tariffs.
No margin risk at all from now?
Yeah, I mean, on balance, because there's 500 companies, but I would say it's offsettable because of the way some of the commodities have deflated. So I think earnings growth is actually still intact.
But sure, we are going to have earnings growth. Growth is intact at far slower levels than we were once thinking.
However, we also know that ISM has been below 50 for 29 months, a record period below 50. And that is highly correlated with S&P forward growth. So if we get the tariffs issue settled and the Fed breathes a sigh of relief, starts cutting, and the ISM moves above 50, I think earnings estimates for next year actually go up.
So you think the Fed coming in and cutting is because they can, not because they have to?
That's right. I think the easiest way for the viewers to understand is Europe uses a thing called HICP as their core inflation, harmonized inflation, which excludes shelter. It's running at 1.9%, and they have a 2.5% ECB rate. If you use
They've cut like 10 times.
Correct. And if you use the U.S. measurement the same way, excludes shelter, because Europe's core inflation excludes shelter, U.S. core inflation is 1.9, and the Fed's at 4.5, 200 basis points higher than the ECB using the exact same inflation basket.
So you think that the Fed should already be cutting?
Yes. I would say that on that measurement, because I'm not the Fed and I don't do policy, but by that measure, they should be.
You can't fall back on that if you just lay out your whole formula as to why they should, that rate should be markedly lower than where they are now.
Okay, then maybe I'd say if I looked at where the 2-year was, like which Jeff Gunlock cites, the Fed is like 3 or 4 cuts behind, yes.
Well, how many do you think we're going to get this year?
Well, I think the market's pricing in 2.6. So, like, let's say 2 is likely, but that still doesn't seem like enough cutting given where inflation is tracking.
So if we're 6,200, we'll call it today on the S&P, what's likely for the end of the year, do you think? What's reasonable? Not likely. You don't need to make an exact number call for me. But what sounds reasonable to you?
Well, so I would advance the argument that the PE should be going up because we had 6 black swans, and the market has proven the resilience.
Going up to what? We're like, what are we, 22 times now, aren't we?
20.
Sorry, I overestimated by a half.
Yeah, but the median is only 16.8.
But that speaks a lot to what got us here in the first place. You've had this massive, large stock rally, right?
Yeah.
So
so I might say, hey, why not the other 493 get a 2 turns multiple increase, and you'd be 6,800-ish.
Can you do that if there are questions about the resilience of the economy at this point?
I think so, because financials, industrials are interest rate sensitive, so I think they would actually reflate on the idea the Fed would be cutting. And there's a lot of tech that actually still has reasonable multiples, and of course we know the cyclicals and the semis would still rise. So yes, I think a lot could rally.
One of the knocks on the rally itself is that many stocks, as we're talking, it plays right into that story, outside of the S&P 500 are not hitting new highs. This record-setting rally would have you believe that everything is going up, when in fact it really hasn't, and certainly not at the same pace, and not even close.
Yes. Well, you know, people always find quibbles with new highs, but we also know that for an institutional asset manager, it is not really excusable to be bearish when the market makes a new all-time high. So in other words, the institutions now have to start adding risk to if we're making all-time high, because it's a new bull market.
Oh, okay. So we're going to get FOMO. That's going to be the next leg, is the FOMO trade?
I believe that is driving capitalism, yes. So a component of it is FOMO.
But, I mean, if you said institutions, you know, hedge funds have been more negative, right? They don't want to be negative and miss the whole thing. So presumably that negativity would turn itself as the fear of missing what could be, in your mind, a much stronger next leg even from here.
That's right. And it's merely a reorientation of perception, because the market's only up 5% year to date, but we could be up 10. So only half of the full year gains have been realized. So if someone had fresh eyes on the market and knows there's Fed being dovish and tariff risks are abating and multiples could expand, I think people could find many stocks to buy.
Okay, well, you stay with us. We will expand the conversation now and bring in New York Life's Lauren Goodwin and Charles Schwab's Kevin Gordon. It's great to have you here. You heard it right here. You sat right next to Tom Lee, and he was espousing his bullishness right in your faces. You agree with it?
I am less constructive on the policy backdrop for this market. Now, I expect that for the next quarter, especially here in the next month, as we have earnings reports start to roll in, what we expected on April 2nd and what we have gotten for the second quarter are different things. And so I think that we'll see an earnings backdrop that's constructive. I agree that we're not likely to see Liberation Day 2.0 type of movement here in the next several weeks. However, I think the reason that the market isn't pricing really the impacts of tariffs is because we haven't seen it in the economic data, and I strongly believe that that's coming. And so, inflation has been incredibly well behaved. The labor market is in better balance. Based on where the data has been in Q2, I agree, the Fed could be cutting. But what the Fed is worried about and looking at is an environment where holiday ordering, starting around now, that's where you're going to see the impact of higher goods prices. That's what where we're going to see starting to hit consumers' pocketbooks in Q4. And so that Q4 timeline is where I think we start to see the impact of the data, which is when I believe the market will react to the risks that are unfolding.
Mr. Lee, you say what?
Well, I mean, a couple things. One is, Q4 is a long time from now. And many people are saying they're expecting tariffs and prices to rise and consumers to think that's inflation. But one thing to keep in mind, a tariff is actually a tax because it is paid and received by the government, which is then recycled, which is different than an inflationary cycle, which is a charge of higher prices to a consumer is then recycled by companies as profits, and it creates an inflation cycle. I would probably be more in the camp that even if goods prices reflect some bump from tariffs, and there's a lot of uncertainty whether that's going to happen, it's not going to be viewed as inflationary. And it's no different than us kind of seeing this as there was a tax levied, it's one time, and
even if that's true, you could still have a negative impact from the tariffs themselves on the economy at large, can't you?
Well, again, but the one thing to keep in mind is the movement in gasoline has already offset the amount of the tariffs. I mean, right, gasoline's down, huge. So I'm just saying that we're not, I think people are using a one model and says this is tariffs, it's 20 billion. It's missing. There's been a lot of changes in commodity prices. And more importantly, you even see it in the ISM surveys. There's a lot of pushback. I think a big chunk of it is being absorbed by the exporter, which means it's not being taxed on the American yet.
Okay. What about you?
I think that from an inflation perspective, I mean, you're actually already starting to see a lot of it show up on the good side. It's just being overpowered by services disinflation and shelter disinflation. I mean, even if you look at the durable goods portion of something like the PCE price index, I mean, the increase that you've seen year to date, if you were to annualize that, it's one of the fastest increases you've seen since the 90s. It's not that it's egregious and it's back to, what you saw during the, 2021 to 2022 supply chain shock. But I would say that, it's already starting to show up. But it's not necessarily overpowering all of the indexes and making inflation, at the headline level go higher. So from that perspective,
are you as bullish as Tom?
Well, for inflation, I don't have as much of a worry as I would for
the market.
But for the market, yeah. I mean, I think that when you look at the sort of the fabric of the leadership of the market over the past couple of months, but that ties into the growth story that has been relatively resilient, but also the inflation story that hasn't been nearly as worrisome. It makes a lot of sense as to why we are where we are in terms of not just one sector or one industry leading, but really the market sort of taking its cue from the fact that the economy has, generally held up better to the points that both Lauren and Tom were making. Economic data have looked relatively resilient. It's the what's coming from here clearly that nobody knows, but I think that just keeps you in a low conviction environment until then.
I mean, how much higher do you think the stock market can go from here?
I mean, if you have a lot driven by multiple expansion, then you've got quite a bit, to go, especially on the tech and the mega cap growth side. Because if you looked at, a forward PE for the Nasdaq or the Nasdaq 100, you still have, pretty considerable upside if you were going to compare to where we've been in prior cycles and beginnings of bull markets, I would say, where you've got a lot more room to push higher. I would say the onus is more on the earnings growth side, not necessarily whether we get positive or negative, but whether that rate of change continues to keep up and you see momentum build build into the third and the fourth quarters, and that comes from guidance that we'll get.
But the note we have on the screen right here from you, in the middle one, can we put that back up?
Yeah.
Let's put that back up, please, so I can see it again, because it said stretched valuations. Stretched valuations.
Yes.
But you're talking about multiple expansion while arguing that they're already stretched.
Yeah, but stretched valuations, I mean, they could stay that way for a while, and that's typically at these parts of the cycle, that's typically what, powers you higher, and then you get the earnings growth to accompany it after. I mean, for us, valuation is more of a sentiment indicator or an indicator of sentiment. So we use it to say, yes, people feel good about the market, but also they're using that as a reason, particularly on the retail side, which is really more of the world that we sit in. For the average retail investor, retail trader who's looking at stretch valuations and using it almost as a sentiment gauge to push stocks higher, that's typically what we see at these points in the cycle. Does it mean that you still have risk to the downside, maybe more so or more protracted in the case that you get a negative catalyst? Yeah, absolutely. And that's what we've seen in the beginning of this year, whether it was everything DeepSeek related. You could bring it back to even the beginning of 2022 when you started to see a lot of really poor breadth divergences and valuations were stretched. There are points where it can be exacerbated to the downside, but it's also a reason that many traders, investors, as we've learned over the past several years, it's a reason that they've used to push stocks higher.
Lauren, when you look at that, do you look at the current price of stocks and say they're just too expensive relative to all the concerns that you still have for what's to come, right? You're buying stocks based on what you think is going to happen in the future, not where you think things are today.
I agree that valuations are stretched and that here in the next couple of months there are, let's say, potential volatility catalysts, but this has not been an incredibly macro-driven market in recent months. This has been a market that's driven by recovery, just trying to digest different policy announcements that really the market has no more visibility into than you or I or others. And so my expectation is that we will continue to see valuations edge higher here in the near term, but that this is an investor's limbo where the policy risks, though they're visible, they're not present in the data. And I think it's important that the impact of sort of price changes and starting to bear out in the market as well, the impact of tighter immigration, less labor supply, could create I'll agree with what Tom said earlier, temporary inflation shock. But when it comes to Fed policy and it comes to market reactions, even a few months worth of inflation moving back the other direction is really important.
Okay, so what about what we're showing you right here, Tom? Yields, which have been backing up again, right? Lately, anyway. I had asked the question a week or so ago to people whether the bond market was going to have yet another flex, whether after the bill passed, the bond market was going to say, okay, I'm going to show you again what I think about these rising deficits and your lack of taking them seriously enough. Is that going to happen one more time, to say the least? Are you worried at all about a backup in rates and the stock market not dealing with that well?
Yeah, I mean, I think as a little perspective, at the start of this year, I remember a lot of folks saying 5% is where we're going to see the 10-year, or maybe even 6%, and people were talking about numbers that were, even possibly double digits. So 4.4% to me is a huge win. But I do think one of the things that investors have to be mindful of is that the CBO does not count tariffs in their budget forecast because it's not legislated. So when you have the $240 billion a year in tariff revenues, which is $2.4 trillion without inflation over that budget period, that's not even in the calculation of the $2.8 trillion being added to the deficit. So I actually think that the bond market is saying the tariffs are actually keeping the bond market in line.
Bonds a good buy here?
We're maintaining our credit exposure in the short end of the curve, not because it's particularly well priced, but because on a, let's say, 2 to 3 year time horizon, that's a corporate backdrop that is still really healthy in the U.S., and I'll buy and hold that all day and clip the proverbial coupon. We're not taking big directional bets in duration precisely because every element of the 10-year pricing, the Fed funds rate, inflation expectations, and the term premium are all in play.
Kevin Gordon, lastly to you, of all of the sectors that have lagged to start this year, right? Let's get away from tech, let's get away from industrials and financials and comm services. which one do you think has the best chance for the most upside over the remainder of the year?
Oh, man. Well, I will say the split that you've seen in what is considered traditional defensives with healthcare staples and utilities, utilities having pulled away from that pack, not just year to date, but over the past couple of years. And they're not a leader, year to date by any means. But I think that some of the strength coming from that and the fact that they haven't been super well bid when you go into these really strong downdrafts, but also they've acted differently than staples and healthcare probably I would argue face a different set of tariff risks and geopolitical risks, are a little bit more insulated. And you add on to the fact there's probably more of a secular, AI-related theme in terms of power generation. I think that move over the past couple of years, and just the strong breadth profile of that sector this year, I think has been a pretty good standout for the sector.
I enjoyed that. That was fun. Thank you, guys. We'll see you soon.
Thanks, Scott.
Kevin, Lauren, and Tom.
돈 벌리게